Hi, everyone. I'm Deborah Winshel, joining you from BlackRock, where I lead our global social impact team, and I serve as the president of BlackRock Foundation. And I'm delighted to be here today with a really great panel. And as we're focusing this whole section on the intersection of technology and financial health, I'm really excited for us to have a chance to dive into short-term savings and the critical role that it plays in building, protecting, and sustaining financial health. And while this conversation may seem more important than ever today, in reality, this was a problem that needed to be fixed well before COVID hit. And that's why we launched the BlackRock Emergency Savings Initiative to help pilot, test, and to build short-term savings innovations in partnership with several of the colleagues you're about to hear from today on the panel. So without any more introduction, let me just quickly introduce our terrific panelists. First, Tim Flacke, who's the Executive Director of Commonwealth, a nonprofit organization that builds financial security and opportunity for financially vulnerable people through innovation and partnerships to change systems. And we're proud to call them an organizing partner expert in BlackRock's Emergency Savings Initiative. Next, I'm delighted to be joined by Daniel Shakhani. He's co-founder of Salary Finance, a fintech that partners with employers to offer their employees low-interest salary-linked loans and other financial wellness products. And last but not least, we're joined by Abbey Wemimo, co-founder and co-CEO of Esusu, a rotational savings and credit building app that allows users to pool and withdraw money for income smoothing, and in turn shares data from each group with credit bureaus in order to improve credit scores. So as you can see, three really terrific panelists joining us today to talk about emergency savings. We have 40 minutes, so I want to dive right in. And before I do, I just want to take a second to remind you that please submit questions to me through the moderator chat, and we're really happy to answer questions, and we'll save some time at the end. So I want to start the conversation. First of all, welcome, gentlemen. And I want to start the conversation by basically some level setting in two areas. First of all, I just want to talk about what is emergency savings, because all kinds of things come to people's mind about short term. Is it building up for sort of a longer term protection? So I want to talk about that for a second. And then I also want to just talk about why in this moment, the criticality of having a short term safety cushion. So I want to talk about those two things, and then we're going to dive into some of the solutions that the three of you have brought to market. So first, Tim, let's start with you, if that's okay. Can you define for us emergency savings? What are we talking about?
Yeah, the key thing that I think is easy to miss and is worth highlighting is what you alluded to. It's not about building something up over time. It's about this ability to build up a stock and then draw on it when you need it and then build it back up. And when you have that kind of access to ability to build up and draw down savings, then you have a sort of first line of defense in your financial life. The other thing I would say is that sometimes we think about emergency savings as a sort of a break the glass moment. You know, this thing we wait till a really big crisis and then we smash through the glass and grab the axe. And I actually think of it a little bit more like a shock absorber, something we're constantly using to smooth bumps and manage day to day. So those are some thoughts.
Abby, do you want to add anything to that?
Absolutely. I view emergency savings as more or less just as a surety fund, if you may, whereby folks can access that capital in the event that there's an emergency. So there's this school of thought, I think Tim rightfully alluded to, whereby it is, emergency savings is categorized as, your piggy bank and you can knock on it, but rather it's just liquid assets you can gain access to whenever you need it.
Daniel, I've had some conversations with colleagues of yours in the UK where they've described it more in this sort of break the glass moment. Really curious from your perspective, how do you think about emergency savings when you guys think about it from really the perspective of salary finance?
Yeah, sure. I mean, it's a really interesting topic, and particularly how it's defined in the United States, where we operate, as well as the UK. So when Tim talks about savings, of course, we all think about it in America 5 years ago when we started the company as savings around your 401k, your retirement savings. Whereas really the savings are essential now, are actually the day-to-day costs and the emergencies that most people are facing. And frankly, unless you can get that right, you can't save for the future. You can't have the opportunity to even have a pot at the end of your retirement to retire with dignity. So this is a challenge that we have tried to address from our start, right at the beginning of this company. And I think all of us, frankly, have an opportunity to make a difference, not just on this call, but the community out there hearing us today as well, to make a difference, particularly in the employer and employee channel in the workplace.
So we're definitely going to get to the employer channel as we move into this conversation. So hold that thought for a second. But if we think about emergency savings, we're sort of talking about it in two ways. One is a cushion for sort of day-to-day events where you might actually need that buffer for an unexpected situation, but also as the foundation for building perhaps longer-term savings as well, which we know is so critical to the future. So if we're thinking about this role that short-term savings can play, yet we're in the middle of this remarkable economic crisis and personal crisis for so many people, whether it's financial or health, how can we be talking about savings? So before we go directly into that, Abbey, can you help sort of frame the context for the situation we're in right now? Because there's so many threads: the health crisis, the economic crisis, all of the sort of structural foundational issues around racial inequity are all really coming together and I think bearing themselves in this moment. Can you talk a little bit about the context of where we are and why this matters so much right now?
Absolutely, Deborah. I think for us to talk about where we are, we need to go back down memory lane a little bit. So I think what we're dealing with, particularly from a racial wealth gap standpoint, we're dealing with a symptom of a larger disease in our economic system, in the United States and globally. And we're owning particularly on Black families and Latino families. The stats are pretty staggering. The average white family has 10 times as more wealth than a Black family in the United States. And the legacy of slavery, of indentured servitude is essentially the theology of this crisis. We've seen situations whereby exclusionary policies from limited federal mortgage loans, redlining for African Americans, and systematic exclusion from the federal housing authorities in 1938 has led to what we have today. The biggest wealth driver for a white family is home ownership, and today for Black families, which were excluded during those critical times, there's nothing to bear. So if we think about the current context, we're dealing with a systemic issue, particularly for Black families, and where we find ourselves is a compounded problem we all have to address. And tactically, what is going on right now is folks are not getting enough income. We don't have enough banked people, particularly African Americans. There's statistics out there like probably over 50% of African Americans are not fully banked. So for us to talk about savings and where we are from an emergency standpoint, we need to look back and go down memory lane to think about the systemic nature of the disenfranchisement of African Americans and what that is causing in society today. And I might add, it's no surprise that over 60% of African Americans today don't have $400 in their bank accounts, which is an utter shame for the wealthiest nation on the surface of the earth.
Tim, I know you've also done some research recently using Fed data around this incredible gap, wealth gap. Do you want to just add a little more context to this?
Sure. I think I might be just extending what Abbey has said, but at this point, I feel like so many of us have heard this Federal Reserve statistic about $400, which the latest 2019 data, I believe, shows 37% of all Americans say they couldn't handle a $400 emergency. But as Abbey's already started, I mean, we looked at that data and then cut it by income. And if you look at the population under $60,000 in income, so that's right around the median income in the country, that 37% pops up to 58% who don't have $400. If we then look at under $60,000 and also women-headed households, it rises further to 61%. And then if we look at under $60,000 and Black households, it's 72%. So a figure that we've all heard and sort of, priced into our worldview, it turns out is just dramatically different for households who are at the intersection, especially of race and income. So I think that's a nice counterpoint to we need to know the history of how we got here, and we need to remind ourselves that we're living it every single day. And the only other thing I would say, just an observation, is that, I think one of the things we've seen in the conversation in this country in this year about racism is that we kind of need to get beyond this idea that it's just about how we treat each other individually, what our individual behavior is, And we need to be open to the idea that there are these institutions and systems that really shape our behavior. And we see a lot of parallels in our work to financial security that we just see over and over again, individual families and households saying, there's only so far I can get in cutting back on the lattes I drink or the choices I make. I also need a system around me that creates the opportunities I need and sort of helps me to attack financial insecurity. So it's an interesting parallel.
Yeah, and I want to talk about some of the structural issues in a moment, but before we get to solutions, and Daniel, I'm going to go to you in a minute, does it seem out of sync to be talking about building savings in a moment where so many families and individuals are under such tremendous pressure just to make ends meet day to day? Just curious to hear your thoughts. Anyone can jump in.
I'm happy to take a crack at it. First of all, Deborah, it's not the most exciting business model, is it, to focus on? And I think that's a fact that most people haven't necessarily put time and energy around it until now. And arguably, you could say anyone who was struggling before the pandemic now has a multiplier effect of the impact on them as a result of this crisis. So there's no doubt in my mind that, sadly, the change that happens in society sometimes happens when there is such a troublesome period that we are having now. So I do think sometimes this will lead, hopefully, while it might be short-term pain for some, longer term, structurally, and both from a governmental standpoint, but also private companies can really combine efforts to try to make a real dent in this problem. And I truly think that we should be looking at the positive in this crisis and look at how collectively we can all come together to actually collaborate and create programs that really do make a difference.
Daniel, do you want to just, first of all, it's interesting because you're coming at this from the UK, which is a very different society. On the other hand, statistically, doesn't look that different in terms of people and their sort of lack of cushion. Do you want to talk a little bit about the solution? One of the things is I look at the title of our segment, the intersection of technology and finance, and this opportunity for innovation that we see every day is being driven by fintechs like yours. Can you just talk a little bit about what the impetus was and how you're bringing solutions to individuals?
Yeah, sure. So the company I represent is Salary Finance. And ultimately what we do, we are a social impact-led business, which is focusing on enabling, as a point solution is how we started, employees to access affordable credit. And fundamentally, if you look at typically how lending models tend to work, we put a lot of emphasis on an individual's credit score, their FICO score. Now, as a result of that, it means that there is a natural bias towards those that earn less ultimately tend to pay the highest levels of interest. So that is effectively the problem we were trying to solve. The way we did that as a company is ultimately to work in partnership with the employer. And as many of you know from things like the Edelman Trust Index, trust is extremely high between employer and employee. So as a benefit, it operates through the employer, which is at no cost to the employer and at no cost to the employee, allowing them to access credit, but in an affordable way. And in doing so, we ultimately able to lend to them. Typically, the application process takes no longer than about 7 minutes, but you can process an application and have the funds into an individual's account in the United States within 24 hours typically. In the UK, it works faster because we have a faster payment system. The byproduct of that is that ultimately we can save the average employee about $1,000 in interest rates. And as a result of that, get them out of debt 12 to 24 months more quickly. And then, of course, that means we can report their repayment of the loan to the credit bureaus. You tend to see an increase in credit score anywhere around 30 to 40 bips. And that's can be quite significant, specifically when you're going from subprime to prime. So that is the model. But then that really plays into the conversation around savings, because if you're paying less interest, and a large percentage of people do typically use it for the power of debt consolidation, paying off high cost credit. And of course, that typically tends to be in the worst form, a payday loan. And we've experienced that problem here in the UK. Once you've been able to get someone out of debt, then they have the option to even consider savings, which may have not been an option before. And I think that's the critical point here. When you touch on the behavioral challenges, it's about when you give people the option to save. And typically, when you give them the option to save at the beginning of that journey I just set out to you, the more likelihood is they are going to save than trying to save at some point down the line, if that makes sense, Deborah.
Yeah, absolutely. And it's interesting because your entry point is via the employer. Abbey, there's so much conversation, particularly this year, around sort of community as people are facing these overlapping crises. Can you talk about the model you built through Esusu, which comes in from a very different angle?
Absolutely. So I think it's important to talk about the theology of our name. Esusu comes from an African saying, particularly the Yoruba culture in Nigeria, that if you want to go fast, you go alone. But if you want to go far, you fundamentally go together, because our futures at the end of the day are all tied together. So what we do at Esusu is quite simple. We form groups of people together, they put money, and then they take turns taking that capital. We also have individual savings accounts, and we report those transactional level data into the credit bureaus to boost people's credit scores. During the course of our business, we've also learned one of the biggest levers for individuals is essentially having access to credit. So in addition to that, we now report rental data, which is the most expensive run rate expense for individuals on a monthly basis, into the credit rating agencies to boost or establish their credit scores. This is not a far cry, and just to underscore what Daniel just said, when my mother and I came to the United States, we didn't have a credit score. We walked into one of the biggest financial institutions in Minneapolis, Minnesota, which has been the epicenter of all the racial crisis going on in the United States, to borrow money, and we were turned away just because we didn't have a FICO score. We had to walk down the street and borrow money at over 400% interest rates from a payday loan lender. My mother pawned my father's wedding ring so we can get his fighting chance and a starting point in this country. So we started Esusu on three core principles: where you come from, the color of your skin, and above all, something like your credit identity should never determine where you end up in life. So really, the focus for us is how do we get clusters of communities to save together, and in the events they can save, how do we increase the leverage, which is debt in this case, cheap debt, which has been the biggest driver of wealth in the United States. So that's what we do. We believe a concomitant approach of savings and building credit is one of the best ways to essentially pave that permanent bridge to financial access and inclusion for everyone.
It's so interesting to me. Your models are very different, but they're both built on two things. One is relationships, yours with the employer, yours with the community, but that you're driven by technology. And Tim, I'm curious, because you work with a lot of fintechs and you've spent a lot of time thinking about this sector. Can you talk a little bit about why you think fintechs have been so powerful in making headway and driving change in this space around sort of financial inclusion and financial opportunity?
Yeah, sure. Well, I was just thinking, listening to Daniel and Abbey, that they sort of draw out some of the best qualities. I guess this is perhaps repeating a little bit what you're saying, Deborah, but rethinking or thinking differently about what the distribution model and the business model for something like savings could be. And this just seems like an important point to name, that it's very, very difficult to make money on allowing people to store up small amounts of money, which they can then draw down very quickly. And so it requires this kind of creativity to say, maybe it needs to be bundled together with credit repair, or in some cases lending. Or the other one that I hear that resonates a lot for our work is to think about who your channel partners are and say, an employer has a lot of reasons to be concerned about the financial security and welfare of their workers, other than making money on a savings product. And I feel like that's the kind of innovation that we see that comes from fintech. So yeah, I think there's something about the ethos of an innovation community that's very helpful. And then of course, there's just the operational pieces of being able to deliver products and services at lower cost in different ways through different platforms and form factors. That's also, we sort of take that for granted now, but is right there in the conversation as well.
As I'm listening to you, you all describe models and this powerful role that fintechs are able to play in this sector. I'm wondering how you think about what success looks like. How do you measure, both for the individual and for your model, particularly because emergency savings, it's not like 401ks or retirement, which is the bigger the better, right? There's this usage component. How do you guys think about, or how do you know if your model is successful? Abbey, you want to start with you, and then Daniel?
Absolutely, happy to start. So at Esusu, we use three core metrics. Number one is the average credit score increase or the established credit scores. And if you don't have a credit score, you might end up like what happened to my mother and I, where you go borrow money at over 400% interest rate. Hypothesis, which is true unequivocally, is if you have a good FICO score, established around 650, you can get access to cheap debt, which is the biggest driver of wealth from a foundational standpoint. So that's number one. Number two is your savings amount. So we have partners. We've actually worked with same at Commonwealth also to essentially make sure people can save well. We have partners whereby we curate things like matched savings, whereby we create a set goal. If you have an exorbitant debt obligation or a particular goal you want to reach, like put down a down payment and a mortgage, how do we help you get to that goal and hold you accountable that money is essentially embargoed for that particular goal? And if you complete that particular task, we essentially measure it and say, yeah, this is an impact. You're either driving debts down if you're paying down a credit card debt or paying down a payday loan debt, or you're using it to put down a payment on your home, which can essentially help you drive wealth. And number three is essentially your cash flow information, because we leverage the power of technology and we do have a tapestry of data when it comes to things like your credit score information, the bank account information. If there's a strong correlation and an habit change of you not missing monthly payments and constantly depositing that amount, what we do see is the first 3 weeks to 6 weeks of our initial savings habit is usually late payments and overdraft fees, which we talk about and help cover. But in the event that changes over the course of the savings duration, which is usually 6 to 12 months, we are able to say this person is changing their behavior and is a long-term saver. So 3 things. Number one, establishing of credit score, more leverage to either pay down debts or do things with wealth building. And number 3, behavioral change, which we think is quintessential to solve this crisis.
Thank you. Daniel, curious from your perspective, how you think about this knotty issue?
Sure, Deborah. I mean, there's two perspectives to think about in our model. One is from the employee perspective, but the other perspective is from the employer as well, right? And then you can look at the broader impact in terms of the national change one can make. So from an employee perspective, there are so many factors for us. First and foremost, being able to get the message to the people that they know there's an alternative out there that can help, right? That is frankly half the battle once you're actually working with an employer. And I would say 5 years ago, when we started the organization, it was unheard of. I mean, it was like moving a herd of cows across a field. Some people were very quick to embrace new ways of doing things, and those were the organizations that really wanted to think about financial well-being as one of the core pillars of well-being of their organizations. Today, it's become mainstream, and so getting the message to people, being able to make it accessible and easy to go through the process is a key factor. Being able to get the money to those people as quickly as possible, but for them not to be able to pay a penalty if they need to pay it back early. And then moving forward, ultimately making sure that we can monitor their credit score and report that back to them and to their employer is essential. So that then drives into the fact that if you can drive retention and ultimately keep the employees or attract employees that you wouldn't have done previously, that's a really key factor in the model that operates. And I think that now we've got to the stage where we've seen significant amounts of interest saves, over 80 million. And as a result of that, you think about how much of that could then go back into a savings program is a very exciting opportunity, but you've got to be an enabler. So I do think that we have now got to a stage as a business where, we work now with well over 500 companies worldwide. And as a result of that, the collective power of bringing those people together, when one employee goes from one company to another, you could effectively re-link into the program, the savings program or access to credit program or financial education, or then, of course, rolling out and thinking about other products that are critical for moments that matter throughout the life of that individual.
Yeah. Yeah, it's interesting. In the world we're entering, portability is so critical, right? For
Absolutely.
any product like this.
If I can sorry, Deborah, one last point, if I may. Portability, not just as an employer, but also the gig economy, the contract worker, which is a massive area which we mustn't forget about.
Yeah, no,
Sorry.
exactly. I'm just, I'm thinking about how, as you both describe your model, scale is the holy grail, right? This is an area where employers, record keepers, payroll providers, the gig or companies, if so to speak, are the ones who really have the distribution. Tim, do you want to talk a little bit about how you see fintechs in their role of sort of driving this system level change and the role that they can play actually to drive some of this innovation into what is a fairly robust and sort of stable system that we have right now?
Yeah, no, I'd love to, and specifically in one area, but I think one thing I want to say to tie us from the last conversation, so we have the luxury at Commonwealth of not being a specific provider, and therefore when we think about success, we get to think about it in macro terms. Mm-hmm. And I would say we don't want to lose track of the supply side. There are still lots and lots of people in this country who we see over and over again don't need any persuading of the wisdom of saving. They don't need, they don't need someone to quote unquote teach them to save, but they really don't have a good option to do it. So I think we should together keep our eye on the supply. And then the second thing I would just add to the great things that both Daniel and Abbey have said is, we tend as an industry, as a group, to focus on the objective metrics. And I think that's right. What are the real measurables? But the other thing we need to not discount is the subjective metrics. And one of the things that's especially powerful about having savings, it's one of the few financial things you do that you feel genuine pride and agency around. And, borrowing money is necessary, but it rarely leaves us feeling better off. And so I want us to keep that in mind as individual firms and also as a collective, that there is something really good for us in a sort of public good way when more people feel confident and secure and as if they played a positive role in their own financial future. But to the question you asked, the thing that we're spending a lot of time thinking about and are super excited about is we have this enormous infrastructure in the United States around retirement. And we have this somewhat rare thing, which is a sort of a consensus that we should have an employer-based retirement system, that makes sense to be supported by public policy, that the robust industry that exists is a good and necessary thing. And so we think it just makes a ton of sense to extend that retirement system and infrastructure to the day-to-day reality for, by some estimates, 78% of us say we feel we're living paycheck to paycheck. So that's a lot of words to say that system should be able to support short-term savings. And I think it's already come up. I think there's good reason to believe that will help with the long-term savings too. But as a starting point, we can just to make sure we address that supply side and make sure more people have an easy, convenient, affordable, kind of smart way to save. And so when then we get to the question of fintechs, a lot of that retirement system, the innovation edge of that system tends to be shaped and driven by fintechs. We talk a little bit about the model or the parallel from the student loan space and how fintechs really drove our attention around student loans as an employer problem, something for employers to pay attention to. And we now see that has adopted or spread throughout the entire record keeping and retirement industry as a feature that you want to offer. And so we would love to see that same thing happen with fintechs showing old school legacy and very large scale providers in the retirement space how they can add an emergency savings feature. And if I could just go on for one more moment, one thing that the retirement system has had great success with is automatically enrolling workers into retirement savings. It's widely accepted as sort of this revolution in the retirement system. And we now see an opportunity to do that with emergency savings, to automatically enroll workers into some amount of emergency savings. Of course, they could opt out. And we have some regulatory guidance from the Consumer Financial Protection Bureau that allows greater clarity for employers who want to test that out, who kind of agree with us. That seems like it could be powerful. So there's an invitation I want to shamelessly put out, a kind of a plug for innovators and employers and record keepers who say we should really test that out and see what we can do if we opt people automatically into emergency savings in the workplace.
Yeah. Tim, thank you. And there was, one comment you made at the beginning that I just want to hone back in on for a second, because it often comes up, and I know it's something you're all so attuned to, that most people want to save. It is a universal feeling, and it's not for a lack of education or understanding or appreciation or financial sophistication. It's usually just, are there readily available, compelling, cost-effective ways to save. And the supply side comment you're making is really what we're all talking about. Make it easy, make it available. And this isn't an issue that a small percentage of our country or the UK are facing. As you say, 78% of people say they're living paycheck to paycheck pre-COVID. So I think it's really important that we're talking about solutions that people are looking for. You don't have to find people or convince them that this is something that they want to do. I'm going to quickly go to some questions, and then we may come back and have time for me to ask a few more. But from the audience, how is the pandemic impacting savings? And do you think that that there will be a change in consumer behavior long term with regard to savings post-COVID or as we move out of COVID? Anybody want to jump in on that?
A couple of thoughts I have, I'm happy to share. So I think if you look at the data, and we do an annual report of 10,000 employees, both in the UK and the US, fundamentally, we've seen there are two types of people during COVID. Those whose jobs have been affected significantly, and those that frankly haven't been affected so much, if I just simplify it. And those that have been affected, the people that have always been advised to save for a rainy day and for unexpected issues, are needed right now, ultimately, to get to a point where they have an unexpected loss and they have a solution there. They've ultimately been in a position where they've had the fortune of being able to do something about it. And people who haven't got any savings are really, really struggling. People having to move back into their parents' home. They have to save on rent. And to Abbey's business, is such an instrumental part of that data configuration and data collection to help people improve their credit scores. And those that do have savings are having to dig into them significantly more than expected, using that to pay for essentials in case the government furlough schemes doesn't cover all their costs or isn't available to them. That's a real problem. I think where jobs haven't been affected, those people who are still getting paid, this is actually leading to a lot more what I call accidental savers. People who ultimately get to a stage where people's outgoings have gone down, but people are in a position where they're not going on holiday. They've cancelled their holidays, of course. And that means people who have never saved have started to save, frankly, more than ever before. And interestingly, one of the things we found is within our own initiatives and working with the government programs like in the UK, the HMRC Help to Save, or with Deborah, yourselves, and BlackRock and JP Morgan on the Nest Sidecar Savings Program, which talks to Tim's point about almost auto-enrollment and bringing people into an actual savings cycle. I think that, frankly, is one of the biggest plays we have today. And then almost getting through to a marketplace of saving solutions that people can choose, to me, makes a lot of sense as well. So almost kind of the part of the problem is that we know there's a big problem in society, I think, but we don't always know how big that problem is for our employees. And I don't think we've talked about that necessarily on this session so far. So being able to measure the size of the problem within your employee base is an essential part of this. And we've really spent a lot of time trying to understand that space and be able to say, if we can save people X amount or help them in this way, this is the outcome we can achieve. And I think that's some of the certainly the ways we've seen it impact the employee base during COVID. Abbey, what about on your side?
Absolutely. Thanks, Daniel. So we have access to real-time data. We can see cash flow information with linked bank accounts. We can also see, the folks are drawing down on the savings accounts, and we have coverage in 42 states in the union. So what we are finding, which is contrary to what we expected and planned for, we planned for disaster. But the news I have for you is we're growing from a savings standpoint 22% month over month. It makes no sense. So we've spoken to chief economists and spoken to a whole bunch of folks in this sector, and two hypotheses come to mind. When we look at the tapestry of data we have access to. Number one, with the CARES Act in the United States, there's a huge influx of capital that came at a big chunk to people that traditionally don't have that access to disposable income. Although there are adverse effects from people being laid off or furloughed, what we're finding is people are actually doubling down on liquid cash. Or rather, when you look at the debt to equity ratio, from a debt standpoint, they're taking on more debt. So it's a very, very interesting revelation. I don't know if it's an evangelism, thanks to the good work Commonwealth is doing and BlackRock and others in this space. Telling people you need to save more is making them not touch their emergency savings or what's in their savings account, rather taking on more debt. the jury is out in terms of what we're going to do to that, what is going to happen to that debt. So, we're seeing savings go up to 2% month over month, but debt to equity ratio is going up around 31% month over month. So that's a big issue. There's no balance there, but the win here from COVID is people know the importance of having liquid cash so they can use that capital in the event they need to use it for an emergency. And thanks to the CARES Act, they have access to that capital. But what we need to be worried about at this juncture is the amount of debt people are taking on. It's quite alarming for us when we see this data.
Yeah. Abbey, another question we just got, which I know is hard to answer in isolation, but one of the questions is, how much should people be saving? Like, what is the right amount of emergency savings for you to have and maintain like good financial health?
It's a fantastic question. From what we see, Deborah, we would benchmark that now to $1,200. It's very audacious compared to what the Fed says at $400.
Right.
We are benchmarking it because we have cash flow data in terms of what people are spending and their obligations. We've also heard stories and data-driven impact of emergencies themselves. In the United States, the biggest driver of bankruptcies is medical bills, right? And so we are having to see, we need to push the goalpost on this, glorified $400 figure, although not reachable for a lot of people right now, but we need to be more audacious. We should never waste a crisis like Warren Buffett talks about. Let's push the goalpost from $400 to $1,200. Why not? When you have a crisis, that's when we have the New Deal under Franklin Delano Roosevelt. I think we should rethink the current structures and not just, settle for something small. And I'll quote a Republican president, although no affiliation. America is simply too big for small deals. We got to move from 400 to 12.
Thank you for that. Another question that's come in, Tim, there was a question about investing spare change, the Acorn model. And I know you look at lots of different ways to drive savings. Are there other models that you've seen that help people put away that extra money?
Yeah, gosh, there's so much out there. I guess, a couple of things that just general principles is when are the opportunities presented? How easy are those opportunities? There are different ways to frame them. So our colleagues at the Common Sense Lab and many others are experts on sort of behavioral, bringing a behavioral lens to it. But I would submit that some of the basics really matter here. Being present at the point of getting paid in the form of the workplace or the payroll company is really, really powerful. And so that's not an entirely revolutionary idea, but one that I'd encourage us to always look at. And I think, there is something about this conversation around dollar amount. We tend to focus more on just saving the activity as opposed to the amount. But I think there's something about normalizing, this touches on the concept of community, normalizing what are people like me doing that people find very helpful and very relevant. And there's probably a lot of ideas that can come out of that. If I could just have one thing, I happen to be looking at this today, so I think it's just really on my mind. This question of the response from the pandemic, it's a story of two worlds, right? Some folks have really been in a position to save and some folks are really not. And one thing we've begun to realize is that for a whole bunch of accidental reasons, the population that lives on very large federal tax credits, so the earned income tax credit, the child tax credit, this population actually may have spent next year's money this year. And I don't think they even necessarily know that. So, I think we need to keep our eye on what lies ahead, even as we all get tired of reading the same, in many cases, depressing stories. The other shoe is going to drop for a lot of our neighbors and fellow citizens, and we need to keep thinking about that.
We are just about out of time. I can't believe it. And before I wrap up, I'm just going to ask each one of you if there's one thing, like in a sentence, given all the focus right now, public sector, private sector, on this issue around financial health and stability, if there was one thing that could happen that you think would really be pivotal to move us forward, what would that be? One sentence. Abbey, I'll start with you.
Absolutely. I think we need to go back to the concept of baby bonds. It's crucial because two major reasons. It will cost us $100 billion, 2% of the Federal Reserve budget. And that's only 8% of what we spend on defense. So Baby bonds is only one of the ways we can equalize the deficits we have from a racial wealth gap standpoint and savings.
Baby bonds. Daniel.
I think the auto enrollment really for me is the key one. I mean, if you look at whatever metric you use to determine whether the UK has been successful at auto enrollment in pensions or not, I think broadly it's been very successful. And I think this concept of opting out as opposed to opting in is really powerful. So I would love to see a scenario where every organization is actually offering savings as a default option. And if you don't want to do it or you want to change the amount you want to save, you can just opt out.
Opt out. Tim, that might have been your thunder. Go for it.
Hard to follow those two. I guess my fantasy is that we could reach a point where basic financial security and liquid savings is not a personal conversation, it's a public conversation. And whether that's through political leadership or cross-sector partnership, we take an approach that we have so much at stake to have so many more of us have some basic reserve that it's time for us to think about this as a national crisis and a public issue, more along the lines of how do we get to the moon and less along the lines of just private sector innovation or just, individual behavior.
Gentlemen, thank you. Thank you for taking the time to share your insights and your observations, and wishing you all a continued success in against this really difficult and pressing issue. Thank you.
Thank you, Deborah. Take care. Bye-bye.